Greetings, my name is Kevin Matthews and I am the tax professor. Remember, class is still in session because the learning never stops. And today we're going to talk about ABLE accounts for the disabled or blind. These are actually relatively new accounts that have kind of come out. I haven't actually been able to use too many of these, as many of my clients don't have the need for them. But I do have one or two clients that actually use them, so I've gotten to know them, over time. The way that this kind of works is that you are able to basically save money and grow money in an account for the express benefit of taking care of somebody with special needs or a disability. And I'm a very big fan of these. In full disclosure, I have a sister with a learning disability and could have really benefited from an account like this. If you want to think about it, it kind of works similar to a Roth IRA. So we use Roth IRAs to make contributions to, you don't get a tax deduction on the Roth IRA, but if you take money out and use it for and you take it out at the specific time that you're retired, you are able to actually receive that money tax-free, including all the earnings tax-free. And that's kind of how these ABLE accounts work. There's a few requirements that you have to meet, and there's some key features to this. And so the first key feature is that ABLE accounts can be created by individuals to support them, by families to support their dependents, or by guardians for the benefit of their wards. So if you have somebody that you're supporting that has special needs, you can use this in order to save that money in order to be able to take care of them. Eligible individuals must be blind or disabled and must have become so before turning 26. And must be entitled to benefits under the Supplementary Social Income, or SSI, or Social Security Disability Insurance programs. Alternatively, individuals can become eligible if a disability certificate for the individual is filed with the IRS. So, if a very good example of this, I'm a disabled veteran because when I served in the military, I had a few things that happened to me health-wise while I was there. And so, currently I'm 90%. And so what ends up happening is I can't use that kind of a disability in order to be able to do this. But if I were, say, for example, 100% disabled because of an inability to work, chances are I would probably also qualify for SSDI or SSI. And as a result of that, it would allow me to have an ABLE account set up for my behalf by a family member who has to take care of me. And so what it would allow them to do is they can, constantly throw money into that account. It could then grow over time. And then, if there's some kind of special need that comes up. So for example, if I have a kid who, say, is 5 years old, and he's blind. I don't, but say I did. I could create an account in order to be able to save up for that child, and then maybe when they get to high school, maybe they want to go to a special needs high school that focuses on people who have blindness. It would allow me to use that money in order to be able to take care of him and give him the special needs, special education that's necessary in order to be very successful in overcoming some of the obstacles that a disability or a blindness can come up with. ABLE accounts are established under state ABLE programs. In other words, the states manage these. I know our state, Virginia, definitely has one because I've worked with them for two individuals. The account may be open under any state program where the state allows for out-of-state participants. I can't imagine a state's going to say that we're not going to allow out-of-state participants in these programs. I mean, you might have grandparents that are living, 4 states away. You don't want to have it to where they can't, contribute to one of these for them. So I couldn't imagine. I've not run into it myself. Maybe there is one, but I'd be surprised if that was happening. They say that majority of states have passed the legislation. Some states that haven't have established their own programs to allow tax benefits for contributions to a program in another state. So it's, again, these are, they're relatively new. They're kind of spreading. As they become more and more popular, I suppose that more and more states are going to actually pass the programs to make sure that they work. Any person may contribute to an ABLE account. While contributions aren't tax deductible, like I said, it's like a Roth IRA. The funds grow tax-free, and the account investment directions can be changed up to twice a year. This is not something that you put in order to make money in the stock market. You're investing it because you want it to grow over time, but you generally want somebody who's going to be looking at this and saying, hey, look, we're going to put you on a path of continuous steady growth, or we're going to put you on a path of more risky growth because maybe this ABLE account is for something that's not going to happen for another 15 years. Definitely something that you want to talk to a financial advisor in order to make sure that it gets set up correctly. Distributions are tax-free if used to pay for expenses that maintain or improve the designated beneficiary's health, independence, or quality of life. So a list of expenses that are examples are housing, transportation, employment support, health prevention, wellness costs, assistive technology, personal services, and other IRS approved expenses. And when they say other IRS approved expenses, that's going to be a facts and circumstances case. So if I've got a person who's blind, and obviously if I have to get a special maybe I'm going to get a special computer program for them so that they can slide the scanner over the paper and that it allows them to read it out loud to them. Maybe I could use it to pay for something like that. That's obviously to help that person cope with a disability. It is not for, for example, if I, have somebody who has health issues and it requires them to do some swimming, I can't go outlandish and build, gold-plated, handles and all that sort of stuff. There's a lot of stuff that they're going to kind of take a look at, and they're going to say, hey, look, yeah, this is lavish, it's way above and beyond, it's not really needed. You're just kind of making this better so that it's better for you. And I only use the swimming pool example because that's actually an example that's cited in one of the medical regulations that they actually use, and that's just because oftentimes they're taking people to court because they're building swimming pools to take care of their own health, and it turns out that they're going overboard on it. But anyways. So an eligible individual can only have one ABLE account. Total contributions cannot exceed the gift tax exclusion. For 2018, that's $15,000, by the way. It is adjusted for inflation annually. However, because it's in $1,000 increments, it doesn't change very often. In fact, I believe the $15,000 is actually a recent number, so I would not expect that to change for probably about 2 to 3 years unless we have a massive amount of inflation in between now and then. For tax years, so basically, we had this new tax law that got passed. And so during the period of this new tax law, the Tax Cuts and Jobs Act, which goes from December 22nd, 2017 all the way till 2026. The designated beneficiary can make additional contributions in excess of this limit, but up to the lesser of the federal one-person poverty line or the beneficiary's compensation. So to be eligible to make these contributions, the designated beneficiary must be employed or self-employed and must not be covered by an employer's retirement savings plan. Okay. There's also a limit on the total balance in the account. This limit, which varies from state to state, is equal to the limit imposed by that state on qualified tuition plans. So if you have, every state has 529 limits that you can actually have in them. I'll be honest with you, I don't know them right off the top of my head. It's just that, and they're going to vary from state to state anyway, so you want to look at those up in your actual state in order to be able to figure out where it is. So ABLE accounts can be rolled over from one ABLE to another ABLE for the same individual, or to an ABLE account for a sibling who is also an eligible individual. Distributions after December 22nd, 2017 for transfers made before 2026, amounts in qualified tuition programs are also able to be rolled over into an ABLE account without penalty, provided that the ABLE account is owned by the designated beneficiary of that 529. In other words, if I have a 529 for, a family member who's got disability special needs, and I also have the ABLE account for them, and maybe they're not going to use as much of that post-secondary education that they would have used, and so I can roll it into that ABLE account, but I have to do it between those two time periods, which is the end of 2026, and now. It doesn't matter if it's but it had to have taken place after December 22nd, 2017. Okay, ABLE accounts have no impact on the individual's Medicaid eligibility. However, ABLE accounts balances in excess of $100,000 are counted towards the SSI program's $2,000 individual resource limit. Thus, individuals' SSI benefits are suspended but not terminated when his or her ABLE account exceeds $102,000. In addition, the distributions from an ABLE account may be used to pay housing expenses to count towards the SSI limit. And I'll be honest, I'm not an SSI person. I'm probably the last person who should be giving any advice on SSI. I haven't dealt with it. I think the last time I came close to dealing with it was about 20 years ago, so any data I would have would actually be out of date anyways. Again, this is probably something that you want to make sure that you're talking to somebody who has a lot more experience in this, and it's not... You can ask me general tax questions about it. I understand the tax implications of it, but the SSI portion of that, I mean, we CPAs generally don't get into the disability realm unless it's just something that we have a passion for a variety of other reasons. If an eligible individual dies, any amount remaining in the account after Medicaid reimbursements goes to the deceased estate or to the beneficiary will be subject to income tax on investment earnings, but not to a penalty. So in other words, if you set this up for one of your kids, and something happens and unfortunately he passes away or she passes away, that money then goes into the estate for that child, but the earnings is going to be subject to the income tax. Now you want to make sure that that gets set up correctly, because if that's not set up correctly, sometimes those earnings can be taxed, and it could be very, very heavily taxed, and so you want to make sure that that gets set up correctly. We CPAs actually work with clients on that a lot, and I mean, not just with this kind of stuff, but also with other types of estate beneficiary stuff. So for tax years beginning after December 22nd, for contributions made before 2026, the designated beneficiary of an ABLE account can claim the saver's credit for contributions made to his or her ABLE account. So the saver's credit is a credit that they get for savings. And so it can actually be very beneficial, especially, generally people who are going to be on disability are not going to be making a whole lot of money. And so as a result of which, they're likely going to qualify for that non-refundable credit. And so that's actually a very helpful thing for them. So one of the things that we would normally run into as kind of a bit of a problem is the income limits that phase outs is like $25,000 for single people and $50,000 for married filing joint on the saver's credit. Well, if I'm contributing to an account like that, I will live in the Washington, D.C. metro area. I mean, $50,000 is practically poverty around here. It's not a lot of money to live in the Washington, D.C. area. Abilene, Texas, different story. What happens is that you can then allow that credit for the beneficiary to receive it, which can actually be very beneficial for them, no pun intended, and allow them to have a reduction of taxes that they're going to owe. Well, that's all I have today on the ABLE accounts. I know they're kind of new. I'll be honest, there's a lot of people who probably don't know as much about them as we would like to know about them. Be patient with your CPAs when you're dealing with them, because like I said, there's just a lot of them who, they're relatively new. I remember when Roth IRAs first came out, there were a lot of CPAs who were kind of scratching their head as to, how are we going to deal with this? You don't get a tax deduction? Well, then why are we worried about it? And there are a lot of tax implications with Roths we talked about in another video. But that's just kind of the way it is. We're still getting more and more information about these as we start using them more and more. I am the tax professor. My name is Kevin Matthews. Class is not out of session because the learning is never going to stop. So I would want to thank you very much for watching this video. And if you have any questions, go ahead and leave a comment down below. Or if you want to reach out to me, you can reach out to me at www.betasolutionscpa.com. That's www.betasolutionscpa.com. And we'll be happy to reach out to you if you want to do a one-on-one talk, or if you just want to ask a general question through our info box. I'll definitely answer those to the best of my ability